battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to another installment of the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 long years, it's been the Stenger family's mission to deliver both clarity and confidence to help secure your financial future. We are back. We're bigger than ever before. Producer Owen is back in the saddle. Welcome back for another episode. Thank you so much for coming back each and every week to see us here, to get the good news, the data, the math statistics, the reasons why you got to stay on your plan. What a phenomenal year we've had in the stock market. I've been telling you all year to stay on your plan, to stay on the course that we've charted out for you. And if you've listened to us, which 99.99% of you have been so happy that you have just stayed on your plan, despite the doom and gloom, despite the calls for the media saying that this time it's different, that things are coming to an end, that the sky is falling. None of it has come true, and I don't think it will anytime soon. We've got a lot to be grateful for, lots of good things going on underneath the surface. So that's what we do here each and every week. If you want to keep getting that clarity and confidence, if you want to get it to your friends and family, subscribe to the show, like the episodes. The biggest thing is subscribing. If you're watching on YouTube, if you're watching on Spotify, if you're listening on Apple, click the subscribe button. That's the biggest thing. So helpful. Thank you for doing that. If you're already subscribed, share it with your friends and family. We just had Dr. Jeremy Siegel on the podcast, Stocks for the Long Run, the legendary Dr. Siegel. And so the only way we keep getting guests like that on the show, the only way that we can keep bringing you this top-notch content is if you subscribe, if you share it. So thank you for doing that. Thank you for coming back each and every episode. This is episode 164, Dead Cat Bounce, which producer Owen tells me he had no idea what that meant. Well, a dead cat bounce is when things are very bad and then all of a sudden they get better and everybody says, oh, this is not going to really be sustainable. It's called a dead cat bounce. So for producer Owen and all of you who may not have known what a dead cat bounce was, that's what it is. I am going to apply the dead cat bounce to China. And I told you last week that I believe China is the Fugazi, Woozy, Wazi. And yes, they are having a nice little run here with all the extra added stimulus that's been pumped into their economy. But I believe it's a dead cat bounce. It's just masking a lot of the weakness that's under the surface. And so what I've done is I have brought out Michael Semblist. I do have some documents ready to go in front of me. Michael Semblist, a all-star on Wall Street, works for JP Morgan, one of their chief analysts and portfolio managers, I believe. And he wrote a whole piece on China, September 30th, 2024, in his Eye on the Market research. He says China's got a lot of problems. China's M2 money supply is at an all-time low. China's PMI, that's their production, that's their industry, tracking manufacturing, is near recession levels. China, residential floor space starts, meaning how much square footage is being built for housing, is down to almost 2002 levels. Not good. Not a good sign that things are working well over there. China commercial and residential property prices down to 2013 levels. We're seeing year-over-year declines in their housing. China consumer confidence at the worst level it's ever been, worse than it was in 2008. China economic activity at the lowest level it's been since COVID. I've got more for you. Chinese year-to-date equity returns, horrible until just recently. Earnings growth, terrible until just recently. And now valuations are starting to tick back up. So all this to say, all this to tell you, it's not that China isn't going to have this increased run temporarily because of the Federal Reserve, their monetary system and their central bank pumping all this money temporarily into the economy. But I believe long-term they are going to struggle. Why? It's not really rocket science. You're like, Nick, are you a China expert? Not really. But I'm just telling you, it's a communist country, so I think they are going to have problems. Now, I did have a little friendly disagreement with one of my good friends and a past podcast guest on Bullish. And he did say, Nick, you were way off the mark last episode. I don't agree with you on China. I'm going to try and bring him on one of these times. We'll debate We'll have to do a little live debate on bullish about China. But I just think fundamentally there's a lot of problems going on. Michael Sembelis said that China is not a long-term investment. It's a trade. There's a lot of people invested in the idea that China's going to work out. There's a lot of globalists that have money invested over there. There's a lot of large pension funds. There's a lot of private equity investors that have tons of money invested in China. And so they really have to hope that this works out. And if it doesn't, they're going to lose billions, if not trillions of dollars. Now, are we going to maybe miss a little bit of the return in the trade short term? Are we going to miss the Alibabas of the world once in a while? Sure. We're going to be in the U.S. right here in the best companies. But when you zoom out and you look past 2024, just these past couple of weeks with the stimulus, and you go back 4, 5, 6, 7, 10 years, 15 years, the numbers don't lie. You cannot get around the fact that GDP is largely made up over there. And number two, equity returns have stunk. So all these people saying China's going to eat our lunch, we're still waiting for it to happen. They got 1 billion people. You would think that if their time was coming, it would be now, and it's just not happening. So a lot of this started during the trade war that President Trump embarked on in I believe that was 2018 now, a long time ago, and it gutted manufacturing in mainland China. One of the other things you're seeing, you can say, oh, the Chinese government says they still have GDP growth. So Nick, how can you say that things are weak? Well, just look at the luxury brands. Easy way to fact check the CCP is you go and you look at Porsche sales. You look at Lamborghini sales. You look at Ferrari sales. You look at the sales of high-end goods from LVMH, Louis Vuitton. All those sales are down double digits, and they're up in the United States, and they're up single digits in Europe. So if things are going so well in China and the Chinese consumer is doing well, why are the luxury brands down? So this is the kind of data that we bring you on the show. I could be wrong in the short term, and maybe China keeps having this little bounce. I believe in the end, though, it will be a dead cat bounce. And that in the end, capitalism, that free trade, that entrepreneurs creating value, not the government trying to get involved with every aspect of our day-to-day lives, is going to drive long-term returns. Michael Sembelis, JP Morgan, wrapped up his article by saying, I don't think it's an exaggeration to say that China is acting somewhat out of desperation, given the severity of the decline shown in the charts. You can go look those charts up in Eye on the Market from September 30th. China's a trade, not an investment. And when you get into international markets, when we interviewed Dr. Jeremy Siegel on Bullish last week, we talked about Europe. We talked about Japan. We talked about international markets in general. He said, when you go overseas, you go international, you go to Europe, you're dealing with a lot of value stocks in general. You're in a value world. So value's good as a trade. Kevin O'Leary said this when we met with him a few years ago, the guy from Shark Tank, if you've ever watched Shark Tank. And when we were sitting across the table from him, we talked about value. He said, Nick, value is always, always, always a trade. It's not to say you can't make money on a trade, but if you're going to be a long-term investor, what do you need to have? What do markets value more than anything? Markets value growth. And so if you're a corporation that produces a lot of cash flow, a lot of profits, and you've been steady, consistent, single digit growth for a long time, maybe no growth, but you're not losing a lot of business. What do? You pay your shareholders all of your earnings out in the form of dividends and buybacks, but you don't have revenue growth. And so your price to earnings multiple, the price that Wall Street's willing to pay for your earnings, is going to be very muted. It's going to be 10 times earnings. So you call that a value stock and you say, wow, this company is so undervalued compared to NVIDIA, or it's so undervalued compared to Microsoft. But your big risk is, are the earnings going to be any different 10 years from today? And if they're not, you're buying a company that really is not going to be a long-term growth prospect. And if a company isn't growing its earnings, at least by the rate of inflation, or exceeding their cost to capital on their IRRs, or you could even look at return on equity, return on assets, that's a major problem, because there's going to be a competitor around the corner ready to eat their lunch at a moment's notice. In capitalism, we have we have a very competitive environment. We have a thing called creative destruction. And so there's new entrepreneurs, there's new entrants coming in. So you got to be careful with these value stocks because there's going to eventually be somebody that will out innovate them. And if you are in a company, if you're in a lot of these companies, you could be in big long-term trouble. So value has a very important place in the portfolio. Why? Because it helps you get through the bad times in the market. It helps you get past the high inflation environments. And if you actually bought the S&P 500 at record all-time highs in December of 2021, and you compare the growth side of the S&P to the value side of the S&P, value has, in fact, outperformed growth for the past few years. That's why we have a 40% weight in value in our portfolio that we manage for our clients. But we have to have a 60% tilt towards growth. Why? Because growth is the engine that's going to let us beat inflation for the long run. And so I was talking to a gentleman the other day. He said, Nick, I love dividend stocks. And he's buying dividend stocks based on their highest yield. And so he's buying Verizon. I'm not talking badly about Verizon. He's buying Walgreens. I'm not talking bad about Walgreens. But what I am saying is if you look at their price return, their price, the price of their stocks in many cases is down 40, 50, 60% over the past 5 years. He said, but I'm getting this 3, 4, 5, 6% dividend. But who cares if you lost 50% on the stock? It's all about total return. And so again, it has a small place in your portfolio, but when it becomes too dominant, when value becomes too big, a portion of your portfolio, you could be in for a world of hurt. And what's happened in China, China used to be the risky growth market. Now it's becoming the value market, just like Europe, just like Japan. And we're starting to see some weakness. If you start looking at your portfolio and say, I've got all this money in China, I've got all this money in Europe, I've got all this money in Japan, you've got a tilt towards value. And then you look at the value stocks in your portfolio in the US, or you look at the small caps and the mid caps, and you may even find out, you add it all up, you say, the smallest piece of my portfolio is allocated to U.S. large cap, high quality companies. I think that's a major risk. You say, Nick, why are you so dominated and so concentrated on having such a piece of the portfolio in the U.S.? Well, these are multinational corporations, and that's what you have to understand. These companies today, Microsoft, Apple, Amazon, Google, Facebook, all of them are selling a large part of their revenue they're getting from outside the United States. They're deriving it from China. They're getting it from Japan. They're getting it from Latin America. So you already have international exposure through those companies, but you have the U.S.-based entrepreneur. Now, somebody also told me, they said, Nick, we've got problems in the U.S. Aren't you following what's going on in D.C.? Aren't you following what's going on with the corruption? Aren't you following what's happening with the deep state and all this stuff? I say, yes, I am. And I'm just as worried about it as you are. But where else are you going to go? You think it's bad in the U.S., but it's somehow going to be better for you in China, or it's going to be better for you in the EU, or it's going to be better for you in Japan. You're out of your mind. You haven't done any international travel. You haven't seen what the rest of the world is like, quite frankly. And my opinion is, if I asked you, where would you like to start a company? You could start a company in any country on earth. Where are you going to start? I would bet you the U.S. is going to be in your top 1 or 2 choices. And if it's not the U.S., there's some other reason why. And the U.S. still, in my opinion, is the last and best hope for entrepreneurs. And that's why we've got the innovation we do. So talking about innovation, that brings up NVIDIA. NVIDIA is up about 3% as we're recording the show today on October 3rd at 2 p.m., right before market close. And you had Jensen Huang, the CEO, go on CNBC yesterday, say there's incredible demand for Blackwell. That's their new platform for artificial intelligence. Now, I don't know where AI is all going to shake out. I certainly am not an AI expert. But what's so exciting about what's going on in the economy now is there's an arms race towards this machine learning, artificial intelligence, robotics, all this incredible technology that is just around the corner. Now, we are in the early stages of this. We are in the early part of this innovative wave. But I would just tell you, look at what's going on with NVIDIA, because that's kind of the precursor to, I think, what's coming with the rest of the S&P when earnings start to come out later this year in Q4, into next year, into Q1, Q2, Q3. I think we're just in the early phases of earnings growth. And so you got to understand what's going on. There's a chain of technology now where these corporations, the standard corporations, remember, we don't just invest in the technology itself. Okay, we want to invest in the companies that are leveraging technology. AI hasn't even touched 10% of S&P 500 names. They're just getting started. And so as we look at our projections for the S&P, remember we went into 2024 saying that the S&P could reach 5,200 points by December 2024, which was a crazy prediction. That was an outrageous prediction last December. Some of you said, Nick, you're completely off your rocker. There's no way that that's going to happen. Well, we were actually wrong in a different way because now the S&P is at 5,700 points. So I'm here to tell you today, yes, we nailed that prediction, and I believe we're gonna come out with our prediction for the S&P in 2025 in a few weeks here. But I believe the S&P 500, maybe not in the next week, maybe not in the next month, maybe not even in the next 6 months, but I believe as you look out 12 months, 18 months, 24 months, what you're gonna find is the S&P is gonna be up double digits. Why? Because earnings are going to be up double digits. Companies are going to do better in 18 months or 24 months than they are today. So October can be sort of this bad month in the stock market. You can have some corrections, some volatility, especially going into the election cycle. But don't forget, after you get past October, after you get past the first week of November, we're going to have gridlock, is my guess. We're going to have certainty in the markets. And the fourth quarter of the year is historically the best quarter. The first year of the new presidential election cycle, 2025, is always one of the best out of the 4 years, usually a double-digit year. Why? Because there's certainty in the market. Wall Street knows what to expect. Companies are more optimistic. We're going to keep getting these Fed rate cuts over time, and you're going to see companies become more and more profitable. So stay tuned in the short term for a little decline, a little correction. When we get past that, just be ready. I think we're going to see some new all-time highs past the 6,000 point zone on the S&P in short order. So be bullish. I think you should be an optimist on the long run of the economy. Professor Jeremy Siegel says he agrees with us. So the professor says, Nick, I'm still bullish 18 months, 24 months out. You should be too. Let's talk a little bit about the election. We'll wrap up because we're getting so close here. The popular vote's probably going to go to Kamala. That's what we're seeing right now with the national polling. But remember, it's more important to look at the electoral college, look at the swing states. So all of the election polling that's being done in Georgia or Ohio or Pennsylvania, Wisconsin to a lesser extent, but Michigan and Nevada and Arizona is now pointing towards President Trump. And I'm not making an endorsement of any political candidate or anything like that. We don't want to get political. But what I do want to tell you is I think there's a good chance at a minimum that the Republicans are going to be in a large part of Washington at the end of this cycle. Because of that, I think we're going to have some good gridlock. I think the craziest tax proposals that have been put out by the left are not going to get pushed through. I don't think the corporate tax rate's going to go up as much as they want it to, if at all. If it does go up, it's not going to be to the tune that they want it to go up. And then the unrealized gains, the crazy idea that we're going to tax people on their unrealized gains, the absolute bonkers idea that's coming out of the Marxist side of the political aisle is not going to happen either. And so don't fear these doom and gloom stories you're reading. There's a very low probability of this stuff actually occurring. And by the way, if the market did think we were going to get completely derailed in November politically, the market would already be pricing that in. We'd be down 20, 30% right now, just like Mexico's stock market went down before they elected a socialist. And Argentina's stock market went up when they elected a smaller government pro-capitalist guy. So that's the reality of how these markets work. They always price this stuff in ahead of time in anticipation. Now, I do have to say, I wasn't going to say this, but I just thought it was so funny. We had the vice presidential debate last night, and just going back to one of the things Tim Walz said that I'm sorry, I hate to even do this, but it was so funny. He said at a campaign rally a few weeks ago, he said, we can't take another 4 years of this. I'm like, man, I agree 100%. This is the funniest thing that was probably said all campaign long. I mean, isn't your party in there right now? You're like, we can't take another 4 years of this. You guys are running it right now. So this is a very unique election in the sense that you had two actual results. You had 4 years under President Trump. You now had 4 years under Biden and Kamala, and you've seen the policies. American public's seen the difference in policies. And so there's less of a hypothetical because in most election seasons, you have a slight favorite in the favor of the incumbent. Well, this time around, there's no guesswork. There's no guessing of what President Trump will do. There's very little guessing about what Kamala Harris would do. You already sort of know what's going to happen under either regime. And so what a lot of this is going to come down to is like what Ronald Reagan asked Americans, are you better off than you were 4 years ago? And I think a lot of Americans, especially in middle America and working class Americans, are going to say, I'm worse off today than I was 4 years ago. And that's what decides elections. And so that's why I believe we're going to have gridlock. That's a good thing for markets. So don't let this throw you off. Don't let this all derail you. Again, the market would be pricing this in ahead of time. Okay. That's enough on politics. Let's finish up here with the bond market. I think the bond market's very interesting right now. We are well into our rebalance process, our due diligence process. We've had Sam Hardy, who co-hosts Bullish with me, heading up our due diligence this year, doing a great job. I believe we had maybe 20 meetings so far. We're going to hit 30 to 35. He told me yesterday. So an incredible amount of time and effort going into making sure your portfolio is allocated properly. And as we interview these asset managers, I believe it's now been 18 out of 20 who have said, guys, you should be adding duration. You should be going out on a longer term bond. You should be selling your 30-day treasuries that we've had now since 2021, and you should go be buying long-term bonds. And so we've been mulling this over. We've been listening to all these people. I'm still in the camp of absolutely not. Now, we posed the question to Dr. Siegel when he was here on Bullish. You go watch the podcast. It's on YouTube. And we said, Dr. Siegel, what do you think about adding duration? And he said in his great way of doing it, he said, there's absolutely no way that you should be thinking about adding duration. Why? Because as the economy does better, if we avoid recession and we get rates down a little bit and company earnings are okay, then what's going to happen is rates are going to start ticking back up. And that's exactly what we've seen. If you bought the 20-year treasury at the all-time peak the other week, you're now down 4% from its all-time high. And guess what the yield is for the year? It's 4.07%. So if you miss time buying the long-term bond, you buy it on the wrong day, you think you got it at a great time, well, guess what? There goes your entire yield for the rest of the year. We were joking internally here because this is what a lot of these target date funds are doing. This is a lot of these companies with their model portfolios. This is what they're doing. They're buying the 20-year treasury. So I sent out a joke to the group here, and I said, like a little girl saying to her mom, Mommy, why can't we afford Christmas presents this week? And the mom's like, sorry, sweetie, your father hired the target date fund to manage our money, so we can't afford Christmas. So don't be like that. Don't put your money in the target date funds. I think it's an absolute disaster. Don't put your money in the long-term bonds. Stay short-term. Stay conservative with the money that's supposed to be conservative. Don't risk your safe money. That's so obvious. But with the stocks in the portfolio, that's where you take your risk. That's where you go out and you buy companies that can grow for the long term. And as long as you keep the math of that portfolio correct, growth money, growth oriented, safe money, safe oriented, you'll be fine. You'll make it through these downturns. It's not like you're not going to go down, but you're going to make it through these downturns to live to fight another day. And so that's the reality of being on a goals-based plan, not a risk-based plan. If you're on a risk-based plan, you're probably every year saying, well, how do I feel about the markets? How do I feel about geopolitics? How do I feel about Ukraine and Russia? How do I feel about Israel and Palestine and Iran and all these conflicts and all this nonsense and the Federal Reserve and all the horrible things that are possibly going to happen? If you're coming at it from that lens, you are going to be event driven. You're going to be reactionary. You're constantly going to be just waiting for something bad to happen and then go try and change your portfolio to adjust to it. That's not a plan. That's not a goals-based proactive plan. And that's what you have to have. You have to set out from the start that this is our allocation. This is what our mix is going to be. This is why we're doing it, because we have a couple years of living expenses set aside in short-term fixed income in case we need it. And the rest is going to grow. And then you can rest easy. You can go on vacation in retirement and not be checking your brokerage app every 5 seconds, which, by the way, I know if you're doing, the technology nowadays is so good. I'm talking to a couple of you, our clients, who are logging in every 10 minutes. I can see you're doing that. don't do it. Don't waste your life checking your Schwab app. Go for a walk. Go for a hike. In a couple weeks here, when the snow starts falling and fall is over, go sledding or something. Do something else. Why are you checking your brokerage app every 5 seconds? Go enjoy your life. So that's my advice to you. Don't get wrapped up into the day-to-day ups and downs of the market. Stay focused on your long-term plan. And when it's all said and done, technology entrepreneurs are driving the charge. They're leading the charge. They're driving innovation. They're driving profits. And the S&P, as you look out 18, 24 months from today, you're going to say, wow, I'm so glad I listened to the Nick Stenger Show. I'm so glad I tuned into Bullish. I'm so glad I subscribed on YouTube, Apple, and Spotify and got the clarity and confidence because I stayed on my plan. So that's the main goal. That's what we're here to do. Subscribe, watch the show, share it with your friends and family, get the clarity and confidence. Thank you for being here. Episode 164. We'll see you next week for episode 165.